Hello and welcome to the No Pricks Allowed podcast with your host, Aaron Buchner from Cactus. I'm Wendy McConnell. Aaron is being very annoying today. I just want to warn everybody.
I'm not being that bad, Wendy. It's just been a while. You're just not used to it. I don't know. Maybe I have to be good. My kids have been home, so I've had to bottle it up, and this is the first time I can just let it all out.
So lucky me, I guess.
Well, I can't do it with my wife. She'd get mad at me. So yeah, it's
okay. All right.
So lucky you and our listeners, they get to listen to my stuff. I'm not being that bad.
Okay.
I'm being me. I'm just being me. And you're still getting used to it.
No, you're being way more than you. So what are we gonna talk about today? What is our focus? Can you focus for a second, Aaron?
I will try and focus. I'll try and bring it back. I know this is not airing till February, but it's for everyone else. It's like we're just back from vacation from summer. Wow, my mind is gone. From winter vacation. So I'm just trying to get back into the swing of these things right now. But no, we are going to talk about critical illness and the benefits of critical illness. And
You mean
I
insurance?
know a lot of people don't want to insurance. Well,
yeah, because you're saying the benefits of critical illness. That doesn't sound right, Aaron.
Not of having a critical illness, but the benefits of critical illness insurance. Yes,
okay.
You are correct. I left out the insurance part. I'm sorry. Yes, insurance part of it. Because it's something that's always overlooked in terms of things. And we've talked about it in the CYA podcast episode where we talked about all of these things that you need to have in place. And I really wanted to kind of deep dive a little bit more into why should we have critical illness? How does it actually work inside a financial plan when you're saving for retirement or even the short-term goals? How does it actually help you along the way?
So I'm confused as to why we need this insurance, because I thought that everything was free in Canada. I thought your health insurance was free.
Well, it's not free because we do pay for it through taxes because we get taxed and we pay for it. So it's not free per se. But yes, when we actually go to the hospital, we don't get a huge bill when we leave, which is one nice thing of it. But it's not 100% free in certain cases. And there's a new report that just came out just at the end of last year from the Canadian Cancer Statistics, which was a 2024 special report on cancer and the impact financially that people actually have from cancer. So this report talks about the impact not only to the government of Canada, because there's an increase of people having cancer and because we pay taxes and the government pays it back, the impact not only to the government, but also to people's pockets as well, because it's not 100% covered. And the report actually found out that on average, people pay about $33,000 for cancer treatment annually. So it can be hurtful. It's not as bad as in the States. And I've seen bills and things that have popped up on Reddit. But for us as Canadians, when we're used to going to the hospital, getting medication and seeing and be able to go home without a bill, to now say, oh no, I have to spend an additional $33,000. It's a lot. But before I go kind of down that road of where the 32,000, I want to kind of cover off what is critical illness insurance a little bit for people, because some people, they don't know what this is and it's new to them.
Right. So does it cover specific things or like just medical in general?
It covers medical in general. So usually we lump it into, when people talk about critical illness, it's generally talk about cancer or heart attack or stroke is usually what we talk about, but it actually goes further than that. There's actually 25 different conditions that can be covered under this type of insurance, which includes cancer, heart attacks, strokes. There's loss of limbs, loss of speech, comas, melanomas, benign tumors. It goes on to 25, and we'll include that down below, or we'll probably show this if people are watching it. What are those 25 conditions that can be covered? So it does go just beyond cancer. If you're like, well, I'm not going to get cancer, I'm like, it goes further, and it does do other things that people have, like Parkinson's, or in my case, becoming deaf from all the concerts I go to. it might work out for me. Like, oh, don't roll your eyes at me, Wendy. Come on.
You're not the boss of me.
But so it does go beyond, but the main one they always talk about is cancer, because the instances of cancer, and it's a growing concern for a lot of people, is developing cancer and possibly passing away, or the medical ramifications from it. So back to the report itself, people do assume, in Canada, it's all covered. I go into the hospital, I'm going to be fully covered, but there's other things that sometimes aren't covered through your visit. And those things could be devices. So if there's a certain device you now have to have at home, you may not be covered through your own medical protection, or the hospital you have to pay, or home improvements. If now, because of what happened to you, you need to change your bed, or you're now wheelchair bound and you have to change your house, that's not going to be covered. Caregivers, if someone needs to come into the house, there are certain medications that aren't covered as well. And then we can even go into just your time to travel. Like I'm outside Kingston. I'm 20 minutes north of Kingston. So it takes me, if I'm able to do the hospital here in Kingston, it'd be a 30-minute drive or an hour plus treatment time every day. But if I wouldn't, I'd have to go to Toronto and Ottawa. I know I'm talking about 4 hours, so 8 hours. So that's a day right there for me in terms of travel to get there and back, and then parking, and then I need to eat. So then I got to do takeout food if I don't pack a lunch. So this is where this $33,000 can come from towards people.
So this is like something that's just for, like, in addition to what you already have. It's a just in case, basically what insurance is for, right?
It's a coverage. So it's taking the risk that you would have and pass it to someone else. So instead of me taking on the risk of, okay, what happens if I get sick and I can't work anymore, instead of me having to say, okay, I now have to fund it myself through another emergency fund. So I've got emergency fund if something breaks down, but now I have to do my own pool of money for in case I get sick. It's, oh no, I can now say, you know what, I'm going to buy this insurance for less than what the amount is, because it's pennies on the dollar, and just pass that risk to someone else, so that if I become sick, they're going to they would give me the lump sum payment that's all tax free should I develop one of these sicknesses, and it won't affect my investment accounts and my returns on those.
So you're saying that, even though we're trying to, invest for, keep, our retirement in mind, invest for that, but we also need to live life. Is this going to kind of tear into that at all?
Not overly. I think people think the cost of it is quite expensive, and there are cheaper options out there in terms of things. Like when we look at it, I just pulled up quotes today. If we talk about $50,000, which in most cases, we usually look at the coverage amount for critical illness. We usually say kind of do 6 months at a minimum, so you can take times off, because sometimes you may have a short condition, but take the time to recover and get better depending on what it is. So 6 months worth of your income. So looking at $50,000 at age 30 for a male is $20 a month, or for a female, it's $22. But those costs can increase over time, because when you turn 45, for a male, it's then $51. So it's $30 more, versus a female, it's $48 in terms of it. But it's not huge amounts of money. And hopefully, if you're able to save a good amount of money on a regular basis, this isn't going to eat into those investment returns and what you're able to actually save on a regular basis.
Well, if I'm really good at saving, and I'm really good at investing my money, and my money keeps growing and growing and growing, can I just kind of dip into my investments to, cover any costs I may run into?
So are you thinking in terms of could I just take money, so rather than buy the critical illness, invest it itself? Or are you just saying, you know what, I have this money saved in my RSP and I take it out?
Well, I know you can't take out before retirement age, so I guess what I meant is take that money and invest it. Aha, you were setting me up, and I did not fall for it.
well, not really. And ours, we can. So we'll talk about that one after.
Can? So these different rules get me every time.
This is why you're here, so I can educate you.
So, thank you.
Sorry. Well, you could. And I have these conversations with people all the time. They go, well, why because as a 30-year-old, you don't think it's going to happen to you, but these things happen, and we see it in the news, and we hear stories from other people that it does happen time to time. Most people assume, okay, cancer diagnosis, it's going to be later in life. So if I'm 30, why not take that $50, let's say hypothetically, for critical illness and put it into an investment account instead and save it? But if we take that $50 and we put it into an investment account, and let's say 7%, I'm going to use lower risk stuff, relatively realistic here, because it's also a medical thing. You don't want to go high risk. We've talked about that before in terms of that. So go listen to the older podcasts. It would still take you 28 years of saving $50 a month before you'd get $50,000 in the investment account. So for 28 years, you're not fully covered. There's actually that shortfall in your life. So after 28 years, so after 58, sure, you'd have the money, it'd be available to you, but everything between 30 and 58, you're going to have to figure out, how do I actually afford this and how much can I actually take out from there?
Yeah, so that doesn't sound like the greatest plan.
No, and people have that, and they're like, well, why wouldn't they have that same idea? It's like, well, why don't I just save it? Because they assume that, okay, these aren't going to happen, but they do. And the prevalence of people having cancer diagnoses between 30 and 65 is pretty prevalent. Mm-hmm. The heart attack and stroke, I think they say, is 1 in 2. Like, there's, someone's going to get sick one time of all your friends. Somewhere it's going to happen, unfortunately. So it's not the best plan for that reason, because you're investing specifically with your tax-free savings accounts and your RSP for a goal of a new car or retirement. You don't want to take that money out and derail the whole thing when you could just take $50 and purchase this critical illness and cover your bottom line.
Okay. So what about what you mentioned before, just taking it from the money you're already investing for retirement?
This one is where it gets a little dicey, and we'll have a picture. I have a nice diagram, so people who are watching on YouTube, it'll be up there, but people are not, we'll see if we can put a link to it in the comments for you. But I have one where I show it with people, because when they look at critical illness, the other thing people weigh out in their head is, okay, I'm trying to save for retirement. So usually I look at someone and go, okay, if you can put so much money away, we're taking money away from that pot. So instead of them being able to put an extra $50 towards retirement goals, I'm saying, no, take that 50 and put somewhere else. And that immediately is that, whoa, wait, I'm putting less away. Now I can't reach my goals. What's the impact? So the table we're looking at shows a breakdown of what happens if there's no illness and no insurance. What happens if you have no illness, but you purchase the insurance? And then what happens if you have the illness, but no insurance, and illness and you have the insurance? So it actually breaks it down into the 4 different methods that can happen. But the first thing I always talk with most people is, it shows in the diagram of the first 2 pages, it kind of shows a breakdown of where are you if you were to purchase the insurance itself. So in this case, I'm looking at someone who is 27 years away from retirement. So they're 38. There we go. And they've got $150,000 saved at 6%, and they're putting $3,600 away a month, or annually, on it. After 27 years, they'll have just shy of $1 million, so about $650,000 in their account. If we just take $50 away, so we're now changing their investment strategy from $3,000 down to $3,600 annually down to $3,000. It just drops the coverage amount by $33,000. So at the end of the day, when you retire at 27 and you don't become ill, there's only a 3% shortfall, or around $30,000 in there. So not a huge impact, really, when you look at it. Like, huge to you, or you're like, it's not that big.
No, I know you're going somewhere. I'm like, come on, let's hear it. Let's hear it.
So the biggest impact happens if you have the illness and you don't have the insurance. That's where the biggest impact is. So in this case, I look at it I did use this from an RRSP perspective, that if I had to take an RRSP after they've been investing for 12 years into it, that account's grown to $362,000. and they have a marginal tax rate of 28%, and they have to pull $50,000 out to cover the expenses that they need, you actually have to take out, because of those tax implications, almost $70,000 out of the account. So now you're like, oh, it's not 50, it's 70 because I got to pay taxes on this, which then leaves you with around $300,000 left in the account. And then assuming that you can still invest after that, the full amount we were before at 6%, the end result at retirement is actually a shortfall of over $170,000.
Wow.
So you've gone from buying insurance and not being sick and being only a shortfall of $30,000 to $170,000.
And that's because that the money you had to take out, you're not making money on that. And so it's just kind of where the impact of the investing over the years, that's what's really being lost.
Exactly. It's that huge impact of that $70,000 coming out and not able to compound on itself. So you've lost $70,000, and that extra money you could have gained would have offset it all. And I'm sure a lot of people this is the other fight I get with people, is the difference between the RRSP and the tax-free savings account. So ours is, with the RRSP, would be taxed. So any money you'd pull out, they're taxed on it. If you had the tax-free savings account, well, I wouldn't be taxed on it, which is true, yes. But all that changes with this figure, and I'll have that additionally down there, is instead of having to pull 70, you're still pulling $50,000 out of that account. And the long-term compound growth still hurts you worse than actually having the insurance and not getting an illness from it, which is which makes sense for most people. I think that's always but I find that's the hardest one. I think, oh, well, it's just $50,000. I'll still be fine. It's like, well, it's not 50,000. It's actually more than 50,000 because of that compound growth over time is where it hurts you.
Right.
And then the last one on there, because I haven't talked about that one, is if you have the insurance and you become ill. So in this case, what happens is, just take the notion of, okay, you become sick and you don't invest for 6 months. So for just 6 months of the year, you stop investing, then you restart. You actually end up only being a shortfall from the original number, from the 950,000. There's only just under a $30,000 shortfall between the two, which is just that little bit that through the 6 months where you didn't invest the money, you lose that little bit. So you're not that far off. We're talking 3% here really in the end when we look at the whole thing. So I always use this diagram to show people, okay, this is the impact of critical illness and if you become ill and what it impacts your retirement lifestyle in the end. Because we're looking at this money, I'm like, this now is the difference between having the life that you want in retirement versus having to downgrade some and maybe not able to do it, or even worse, now having to work an additional 2-3 years to make up, because now you have to make up, in theory, $170,000. You may have to work an additional 3, 4, 5 years potentially to get that money back in your pocket. And I don't know if a lot of people want to do that extra work. I don't know, not having to force myself to do it. I'd rather not myself.
Yeah. So your expertise is, cover yourself, cover all the bases and make the most of what you can to have the best retirement possible.
Absolutely. Because you want this money is set aside for a specific reason. It's set aside for your retirement. And the last thing you want to do is have to take it out and delay your retirement or downgrade your lifestyle. And if $50 a month or $20 in some cases is going to protect you and allow you to still achieve your retirement goal, it seems like a no-brainer in my case when I look at it. Like, why wouldn't you protect yourself and have that? Because it is that difference between retiring at 65 when you want to versus maybe having to work till 70 because now you're forced to. And I think that's the biggest thing. It's not the fact of it's being forced to work when you don't have to. Like, they've got almost someone's twisting your arm and saying, too bad, now you have to work more. And I think most people are like, well, I'd rather retire when I can and when I want to, rather than being forced to work extra years because of something that was drastic in your lifestyle, and changes your life, and say, no, guess what? You're going to have to keep working because of this.
Well, and, things are a little bit different because I am in the States and you are in Canada. But, one of the things that kind of gets to be a problem is, okay, well, I'll pay for this insurance, but then I also have my life insurance, and then I have my disability insurance, and then I have the homeowner's insurance. And, it just all adds up.
I'm not going to deny the fact it can be expensive, and it can be daunting when everyone's initial thought is, okay, I need to save for retirement. So I need to put everything away that I have saved after my basic life, like just buying groceries and my bills and utilities and a little bit of fun I'm able to have. I'm supposed to put that all into this pot for retirement. And I'm saying, no. Yes, put that pot there, but now I'm going to take that little bit out to cover yourself. But when you look at the numbers, I think that's where people need to think about, is not just, okay, how do I get to retirement as quickly as possible with the most amount of money, or putting it, maximize this. How do I also protect myself along the way? And that little bit of money that we're taking out, and when you're talking about a small piece that's going to protect you so you don't have to work those extra years, that's what you want to do with this critical illness. And that's the benefit of the critical illness insurance, is that protection and safeguard, so that if something happens to you, the rest of your plan and financial plan doesn't fall apart. Because if you're critically ill, you want to take the time off when need be. And the last thing you want to be thinking about while you're recovering from this is, what do I do now? How do I financially recover from this and do the things I want to do? And it shocks me as a Canadian when I see I've seen bills, and I don't know if it's the norm for a lot of it, but it's like, I don't know how some people financially get out of those wrecks and that's millions of dollars. And I'm talking about just tens of thousands here in Canada. But even that, to put it on, sure, people can say, oh, I can put it on my mortgage, but that's now another cost out of your pocket. And what's the long-term effect? And does it actually help you? Like, there are little things people can do, but $50, like, to me, it's a no-brainer to cover your tail and be like, it's done, rather than, okay, how do I pay this off? It's the last thing you want to think about when you're recovering.
Okay. So if people have more questions, they can get in touch with you to learn how they can do, covering themselves, living a little bit now, but yet still saving for the future.
So I could be reached at my website at prickfree.com. I'm on social media as well. I'm very active there. So I know that we'll have everything down in the comment section where they can meet me. And ultimately, you can email me at aaron@prickfree.com. And that's AARON, just in case people don't know that.
All right. Thank you, Aaron. I'm glad that we got through this, fairly painlessly. Hopefully, we'll keep up with that. So thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to the No Pricks Allowed podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.prickfree.com or give us a call at 613-876-9899. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Cactus. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The contents of this podcast do not constitute an offer or solicitation for residence in any other jurisdiction where either Aaron Buchner and/or Sterling Mutuals is not registered or permitted to conduct business. The opinions expressed are those of the authors and do not necessarily reflect the views or opinions of Sterling Mutuals, Inc. Mutual funds provided through Sterling Mutuals, Inc. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the prospectus carefully before investing. Mutual funds are not guaranteed, their values fluctuate frequently, and past performance may not be repeated.